All right, so today, as I pull this down, we're going to start talking about working capital. If you recall briefly with the cash flow statement, we had laid everything out historically. We started to think about projections, and we realized with the cash flow statement, there's a lot of missing pieces, right? Especially in cash from operations. You're missing, let's see if I can pull up. You're missing the depreciation. You're missing deferred taxes, which we learned is built on, it's built upon depreciation. We're missing working capital. And that's pretty much all of the cash from operations, with the exception of net income and then a few of these other line items that we have to project kind of on a one-off basis. So we learned last week, how do you think about that? Just, kind of, they say quick and dirty, right? How do you just think about making quick projections, but not as crude as just saying zero it out, which I see a lot of people do. Just giving a little bit more thought to it. And then we start to think about, okay, well, before we really don't have a complete cash flow statement until we build two major supporting schedules that support the continuity between all three statements. One is depreciation, so we completed depreciation. We talked about how deferred taxes is based on depreciation, and we started to lay that out. And now I want to talk about working capital. So I want to talk about what working capital is, why it's there, and how it's used. So do you guys have any exposure to working capital? Do you know what it is? Do you know what it's for? Anything? Any question on the test?
Working capital measures and changes of your cash flow.
Yeah.
For current liabilities and current assets.
What? Yes.
Yes.
Correct.
And so if it's some of the total working changes in operating capital is positive, it's a drain on the cash flow.
Correct.
And if it's negative, it's an increase in the cash flow.
That's right. So we'll get to all of that, but it is basically working capital is a measure of your current assets and your current liabilities. So we didn't really talk about the balance sheet yet, assets, liabilities. We will, but an asset, you should know though, because we did the brief income statement, cash statement, balance sheet flows, you should know that a balance sheet is made up of assets, liabilities, and shareholders' equity. And an asset, definition of an asset is a resource, some sort of resource who's expected to provide some economic benefit. It's an asset, right? So examples of assets are cash. Cash is a resource. Property. Property is a resource. You expect property to produce something of value in operations. Inventory. Inventory you expect to sell. These are assets. A liability is a debt or obligation. So liabilities are, examples of liabilities are accounts payable. A loan, liabilities. And then shareholders' equity is the equity invested in the business and the retained earnings in the business. So we'll talk about that. Assets and liabilities are broken up into two pieces, current and non-current. A current asset is a resource whose expected economic benefit is expected to come within a year. So a good example of a current asset is inventory. You have inventory, you would hope to sell that inventory within a year. It's a current asset. Cash is a current asset because cash is actually converted, it's cash already. Accounts receivable is a current asset. Accounts receivable is what the product that the customer has received on credit. And accounts receivable, you'd expect the customer to pay you within a year. If they're not paying you within a year, then there's probably some sort of issue, collection issue. That's a current asset. Liabilities are also broken up into current and non-current. And a current liability is a debt or obligation that you have to pay this year. Short-term debt, you got to pay this year. Accounts payable, probably expected to pay within a year. It's a current liability. Long-term liability is not. So working capital is a measure, is a snapshot of your current assets less your current liabilities. Okay, why do I care about my current assets and my current liabilities? Yeah.
It's kind of your short-term resources or liabilities.
Exactly.
On the company.
Exactly.
You cannot manage that, your business cannot run.
Yeah, it is a picture of, in the short term, the assets and liabilities. What will be converted into cash in the short term and what you have to pay in the short term. There's a good short-term snapshot of cash availability or cash need. Okay. Now, so let's pull up the slide. So, for that reason, working capital is seen as like a measure of liquidity, short-term liquidity. Right? And there are people in companies that are their jobs are to manage your working capital. Make sure you're managing it and balancing it and managing your receivables with your payables and all of this stuff so that you don't have some major unforeseen cash shortfall, or so you have a good snapshot as to what the cash need will be or what the cash availability would be. In investment banking, we focus on a narrower definition of working capital, and it's called operating working capital. Operating working capital is a narrower definition of working capital. Oh, I knew it. I brought my markers. I forgot to take my markers back, and they're gone. No. Always left with bad markers. It's too bad. Okay. All right. Well, just for illustration here, and then I'll run and grab markers at the break. We'll just do one note. That way it'll record better anyway. So what I really just want to lay out something very simple is I want to lay out what operating working capital is and its importance. Okay, so basically I'm just going to kind of draw out some of this. So basically working capital, current assets. Some examples of current assets are cash, okay, as you know, accounts receivable, okay, inventory. It's good examples of current assets. Good examples of current liabilities, and I'll enlarge this in a second. Good examples of current liabilities are short-term debt. This is actually better because I have terrible handwriting. Short-term debts. Accounts payable. Accrued liabilities. Okay. These are examples of current liabilities. And your working capital is your current assets minus current liabilities. That's what it is. Okay. It's your current assets minus current liabilities. If your working capital is positive, then your assets are greater than your liabilities, right? You have more resources coming in. Erdal, you had a question?
When you say short term is 1 year or less than 1 year.
That's correct. Anything current is 1 year or less than 1 year. Now, operating working capital is your current assets, but not including cash. Can I do strike through? Bold, can I do strike through? Yeah, excellent. And your short-term debt, not including liabilities. I thought that they would by default. That's just, you just have to memorize that. Operating working capital is your current assets, not including cash, and your current liabilities, not including short-term debt. Why do I care about operating working capital over just straight-up working capital? Because a lot of times, a couple ways of looking at it. One, if you remove cash and you remove short-term debt, what are you left with? Accounts receivable, inventory, accounts payable, accrued liabilities. These are items most directly related to your operations. Right? Accounts receivable is related to revenue. Inventory related to COGS. Accounts payable, COGS. Accrued liabilities related to expenses. Okay, so this is a good measure of the cash to come straight from your operations. And people want to know that. They want to know what your cash is from your operations. Operating working capital, the cash from the operations. Also, a lot of times, cash can be infused in these numbers to mask a potential shortfall. So if my liabilities are greater than my assets, a working capital operator can just say, oh, let me just kind of put some cash in this now, and it'll look like my assets are greater than liabilities. So a lot of investors kind of like to look at operating working capital better because it's a better measure of, all right, well, just from the operations it's producing continuously what's being produced, right? Take cash and short-term debt out of the equation. Take the financing side out of the equation. Okay? That's the point of operating working capital. Okay? So in modeling, we handle that. And then we look at it this way. And also because cash and short-term debt are managed in a different schedule, the debt schedule. So there's a lot of reasons why we don't look at working capital. We look at operating working capital. Okay? So, next point. How do we think about projecting these items and looking at these items? We think about it using a measure of days. And I'm going to explain what days means. So let's say I have a company, and let's say 2017, let me just, 2018, 2019. Okay, well, that's fine. Let's just stick with 2017, 2018. Okay, let's say I have a company. Maybe the font size, good. And let me say that, let's say in 2017, the company had accounts receivable of $25,000. Okay, in 2018, accounts receivable went up to $50,000. Okay. Let me insert. What does that mean? Accounts receivable increased.
You think there's a decrease in cash, but there will be an increase in cash receivable? So it's going to decrease your cash flow.
It's going to decrease your cash flow, but I'm talking like theoretically, like what's going on.
Oh.
It's going to decrease your cash flow, but for other reasons.
So basically they've provided services, but they haven't received cash yet. Right? And therefore
Is it good or bad? Let's start there.
Oh, it's good.
Let's start there. No, I should have rephrased the question. I know, I left it open-ended. Is it good or bad? Let's start basic. No, you're right. You're thinking about it right.
You can't say it's good or bad. It depends on how and when they're going to receive it, right?
Maybe. Yeah. Is an increase in accounts receivable a good thing or a bad thing? Okay. Why do you think it's a bad thing? Right.
Because, which means you have more chance to get your money back.
Okay. Could be. Yeah. Could be you have a collections problem.
Yep.
Or at all?
I think it's good.
You think it's good?
If you have a long history with your business, you can anticipate it with what kind of percentage you cannot get your account receivable. You can make your projection for that about your account receivable, and then you can manage it somehow instead of going to business without anything.
Mm-hmm.
You know, I mean, I'm clear or not, I'm not sure.
A little bit. To rephrase that.
I think account receivable is good if you have this long history for your business. And I'm sure you have also good relation with your customers to your own business.
Yeah.
And even if you cannot take your account receivable some percentage of that, because of your history, you can anticipate that what kind of problem you will have in the future if you cannot take your account receivable.
It's good to have accounts receivable for sure, because you're establishing a relationship with the customer. But what about just the idea of it increasing, like the year-to-year increase? Is that a positive sign or a negative sign? Right there. What were you going to say, Wenji?
Yeah, on one side it is written because your revenue will be growing, but on the other side, the liquidity situation is very slow.
Yeah.
So it's a bad.
So you make an interesting point about this increase could potentially be good if your revenue is growing, right? What if your just business is doubled? Then maybe it's fine.
Percentage you say.
So my point is, it could be good, it could be bad. And you have a good point of why it should be bad, right? And Wenji has a good point of why it could be good. The question is, looking at any one of these line items absolutely won't tell you if it's good or bad. You need to compare it. You need to compare it to some measure of operations. And that's what days is. So in other words, an increase in AR could be bad if your business isn't growing. If you're producing the same revenue year after year and your AR is increasing, then you might have a collections problem. Right? An increasing AR could be good, though, if your business is growing in line with that revenue. So that's why we always want to look at each one of these working capital line items in tandem with an operating line item. In this case, for example, revenue, because AR is based on revenue. So for example, if my revenue was $100,000, okay, then that means my AR, I'm going to do percent of revenue, was 25% of revenue, right? Great. In 2018, if my AR was $100,000, then my AR went up to 50% of revenue. Now there's a red flag, potential problem, right? However, if my revenue had doubled to 200, meaning my AR percent of revenue held at 25%, then that increase in AR might not be a bad thing, because this is basically saying that my AR increased, but it's increasing in line with the standard revenue growth of my business. So proportionally, even though my AR is growing, the number of customers on receivables is proportionally the same. Do you see what I'm saying there?
So the correlation.
It's the correlation. Exactly. Okay? You want to look at AR as a percentage of revenue. Okay, so days, okay, is basically taking that percentage and multiplying it by 360 or 365 days. It's your choice. Do you use 360 or 365? Accountants often use 360, or we do that in modeling because 360 is easily divisible by 12. So if you ever have to break up your model into 12 months, you can do that. Otherwise, if you're working on a base of 365, then you got to worry about the days that are 31, February that's 28, and all that stuff. So I always do 360. My point is 25% times 360 is 90. 90 days. Basically saying, of all the revenue recorded in a particular year, 90 days of it is left outstanding. And what does that mean? It's a number that you use to compare. You just got to compare it. So if those 90 days has held, it's a good indication that your increase in AR is probably okay. If that days is increasing, going back to the situation where the revenue stayed flat at 100, which means that's 50% of revenue, which means we're at 180 days. There's a potential issue that Erdal was suggesting and Wenjing was suggesting, or Ray was suggesting.
Is there any kind of percentage, is there any kind of line that the revenue and percentage to each other criteria, let's say out of 40%, the company still can be good shape, but after that can be bad shape. Is there any standard for that?
It depends. So oftentimes for AR, people say customers should pay between 30, 60, 90 days, and every company has their own policy. Some companies have a shorter window, but usually it's 30, 60, 90 days. If it's outside of 30 to 90 days, it's usually a problem. Yeah. So my point is, the days measure gives you a reference point for if a change in working capital is a good thing or a bad thing. And to Erdal's question, you kind of want to be within 30, 60, 90 days. So what we do is we take a look at the historical AR, the historical inventory, the historical payables, historical liabilities, and we calculate our days percentages, our days metrics. And we use those as guides for what next year is going to be like. That's what we do. But it's important to understand what these days numbers mean. And for each line, we want to look at what's the comparative operating item. So in other words, inventory is related to cost of goods sold, not revenue. Accrued liabilities is related to OPEX, because it's expenses that you got to just think about what line item is this referring to. Okay? Now, when we're looking at historicals, okay, I want to give you some, let me insert. There's a little addition we make to the formula. Okay, so basically, oh, you got to just do this by clicking one cell. I'm getting used to the way this is. Insert left. Okay, 1, 2. Okay, let's say we have 2015, okay, 2016. And let's say we don't know what our future AR is going to be. Okay, let's say historically, 2015 we had 15,000, 2016 we had 20,000, revenue we had 50,000. Okay. Now, I told you for 2016 to take the AR divided by revenue times 360, basically. Right? Yes? Now, actually, the way we're going to do it historically is you want to take an average of AR. You want to take an average of 2015 and 2016 AR divided by the current year's revenue. You don't average the revenue. You average only the balance sheet balance divided by revenue times 360. Why do we take an average? Well, because revenue you don't. Because revenue, when you see 2016 revenue, this is all the revenue generated throughout the whole year, from January to December. That's revenue. Balance sheet isn't like that. The balance sheet is, this is $20,000 where we stand at December 31st. But you don't know in the beginning of the year if that was zero. That could have been zero at the beginning of the year. That could have been 100,000. You don't know, and we don't know. So for that reason, we average 15 and 16. So we take that average, we divide it by 50,000, and multiply it by 360. Yes?
You say you don't know the beginning of 2016?
Mm-hmm.
Because it should be like 1,500,000, right?
Yeah, well, that's why. So that's why we average the two.
Yeah.
Because
Yeah, because the end of the period of the
yeah.
account receivable should be the
Yeah, so let me rephrase. We're saying the same thing. So if you just used 2016, that you don't know, you're not incorporating where it was the beginning of that year. Okay? 50,000 is basically how much has been generated in a specific year. 20,000 doesn't tell you that. 20,000 is where it's at right now. It doesn't tell you where it's coming from. So for that reason, so we do know 2015, we know, but the formula doesn't know that. So we have to incorporate that into the formula by taking an average of 15 and 16. That's probably better.
What do you mean by you don't know where it's coming from?
Well, when this says 20,000 in 2016 year end, you don't know where it's been all year. It could have been zero and then it generated 20,000. It could have been $1 million in 2015 and dropped to 20,000. We have no idea because balance sheet is a certain point in time. So the best thing we can do is average last year and this year. Maybe that's, yeah. Good that you clarified. Okay, so my point is for the historical calculations, the formula is you actually take the average of the balance sheet line item divided by the revenue line item times 360, okay? And we talk about that here, and we basically just did this on the one note, okay? Okay. So what I want to do is I want to look at it for real. Okay, so let's go to the model. If you notice, we have an operating working capital schedule where we've laid out certain asset line items and certain liability line items. Now, operating working capital is not a schedule that's identified in the annual report. The annual report does not have a working capital schedule. We have to create that from scratch. So it's harder to see here because I've laid it out for you in a template, but if you didn't have this template, or if you had a template but it wasn't laid out like this, you would have to think about, okay, what line items am I including for working capital? And so we have to go to the balance sheet and we have to identify the current assets, not including cash, and the current liabilities, not including long-term debt. So let's do that. So we're going to go to the annual report. We're going to go right to the balance sheet. Okay. And we're going to identify the current assets, but the ones that are related, that are not related to cash. So we're not going to include cash. Okay. We have receivables. We have inventories. We have prepaid expenses. Okay, discontinued operations we're not going to include. We're not going to include extraordinary items. Okay, discontinued operations is an extraordinary item. So we have 3 line items that have been identified as operating working capital. Receivables, inventory, prepaid expenses. Okay? On the liability side, which of these are working capital? These are all current liabilities. Which of these are related to our operating working capital? What would you include? Accounts payable?
accrual liability,
Accrued liabilities?
accrual
Income taxes? That's it. Everything else is debts, short-term. This is debts. This is debts. This is debts, and this is non-recurring.
Why don't you include discontinued operations in the
Because it's extraordinary. Yeah. Yeah, it's not. We want things related to our operating. Yeah. Correct. Okay.
And also, sorry,
yeah.
Why can't you just go directly to like the cash flow statement and take it from like?
Because, and we'll talk about this once we're done with this part. if you've done this before, if anyone's happened to do this before, you will realize, we've identified 6 line items, right? You will realize that in the cash flow statement, where is it? There's only 4 line items here. This will never match. We'll talk about the cash flow statement in a second. There's a reason for that. It won't match. So I believe that going straight to the balance sheet is more accurate. Right? These are balance sheet line items first. The reason why they don't match, we'll talk about the reasons why. They're either consolidating or they're laying them out a little bit differently. But if you want to get to the source, it's the balance sheet, because we're identifying balance sheet line items. You got to go to the balance sheet. Okay, so I've laid those out in the template. We now need to lay out the hard codes, and I don't, just like what we did depreciation, I don't want to hard code it here and then have to hard code it again in the balance sheet, just thinking ahead, knowing that we're going to have to hard code the historical balance sheet. I'm just going to lay everything out in the balance sheet first and then link things in. So let's quickly go to the balance sheet and just lay out the line items that we've identified as working capital, so receivables. They only have 2 years. I'm just going to do 2 years. That's all we need is 5937. Okay, and the year before is 5089. Okay. Yeah. Inventory is 40714 and 36437. And prepaid expenses is 1685 and 2960. Okay, just make sure you got that. I can zoom in for you a little bit. Okay, you guys have that? Okay, might as well just kind of lay out everything. Let's lay out the liabilities. Not everything, but I mean just like the current liabilities. So accounts payable, 36608. Yeah, Kevin, that was from the depreciation. We laid out the PP&E. And 33676. It's accounts payable. Okay. Accrued liabilities is 18154. 18701. Okay. And then finally accrued income taxes 1164 and 157. Okay. Okay. Good. You guys got those numbers? We're going to use these to drive our historical working capital, to figure out projections, to figure out historical analysis, to use our projections. Okay. Oh, one thing. Did I have a mistake in my model? Wenjing, did you find something? Was that something that yeah. Thank you. Yes. One thing. Thank you for catching that. So I did a quick alt equals to sum up the columns in the cash flow statement, and it includes this $1.46. Small thing, but it would actually in the end prevent us from balancing. You just don't want metrics in your totals. So I just need to recalculate, and it might have happened somewhere else too. In your cash and finance activities, just make sure, you might have done this already. It's just every individual line item, but excluding the $1.46. Okay. Just going to make a slight adjustment. Thank you for catching that. And I might have done it. I'm going to just double check everywhere. I didn't. That's one. We would have identified that when balancing the balance sheet. It would have come through. But yep, I did it even with the CapEx here. Okay, you just want to make sure you're not including the percentage drivers, because they will add to your total and they will impact the balance. And we're fine up here. Yeah? Thank you. Okay, do you see what I'm saying, everybody? Did you guys catch that? Maybe you didn't have that mistake. Maybe you... Okay. Now, working capital, let's take it line by line. I want to pull in the two historical numbers that I've received, that I've hard coded in. So I'm going to pull in the receivables. Okay, let me zoom in so we can see this. And then I want to use the historical formula that we just talked through to build days receivable. So I want to take the average of the 2011-2012 receivables divided by 2012 revenue times 360. Okay, so I'm going to put in F8 equals average, open parentheses, that's the average formula, F7 comma E7, okay, divided by revenue. In 2012, okay, times 360. And remember, I think a lot of people really aren't taught to think through what this is doing. Remember what this is doing. It's very simple. It's just taking a percentage of. It's how much, what's the revenue, how much of the revenue is receivables. So we're basically taking a percentage. It's the revenue divided by receivables. It's a percentage of that. And just take that percentage and multiply by 360 to give us the number of days. Now this is giving us a very small number of days, 4.4. Is that unusual? Does that make sense?
It depends on the revenue. Does that have to be metric, like basing on like the income statement or something, or can it just be what I can do?
For the projections?
Yeah, for projections.
It could be what you think. But I guess, okay, but so why is it low? Yeah, let's start
Well, I
there.
think it's because Warlock is so huge, right? And that has so much power in negotiation. So it doesn't really like it's exactly so it's not unusual to have it go
How about payments?
So you're saying economies of scale.
Yeah.
So you're saying that means every, let's say, Fortune 10 company should have low receivables. Might not be the case.
Yeah.
Good thinking, though.
I haven't never been more about this. I was just wondering how I can only pay cash or can use card?
Paying a credit card is still cash.
Yeah.
Because if you pay the credit card, Walmart gets the cash. The credit card, what's on credit is dealing with, the banks deal with that.
Which I thought you only can pay cash, so you it's really low liability. No receivable is what I'm thinking.
I mean, I don't know. That's what I'm thinking. It's Walmart is a huge percentage of customers walking in. You're not contracting with businesses, and so most of the sales are cash sales. Credit card is still considered a cash sale.
Oh, so, okay.
To your point, a credit card is a cash sale, is what I'm trying to say.
But you have to collect money from
to-
the credit card company, so probably will take longer. 60 days? I have no idea.
No, if I was Walmart and you came up to me and you gave me a credit card, I get that right away in cash.
Okay.
At the fee. It's the bank. You got to pay the bank later. The bank has the credit, the AR. The bank books the AR.
Doesn't Walmart also get all that payment end of the month from the bank?
Yeah, that's what I'm saying. Yeah, they get it right away. Yeah, within 30 days. They get it probably. They probably get it faster than that. They probably get it within 12 hours. So that's why. On credit means a company comes in and buys $50,000 worth of things, and then Walmart says, "We'll send you an invoice. Pay us later." That's on credit. That's on credit. Your customers can't walk in and do that, and Walmart's not in that business. Maybe they are in that business a little bit. I don't know. Maybe they are. I don't know. But this is retail, right? Okay. Let's do inventory. I'm going to pull in inventory, balance sheet. There's our inventories. What's going to be our formula here? Link it in real quick.
Averaging inventory over revenue.
Not revenue.
Also,
Cost of goods sold. Okay, good. So average. Oops, what did I do here? Average. This year, last year, divided by cost of goods sold times 360, okay? Now, why is that higher?
Walmart is time to pay back. Walmart's Walmart is doing this, they take longer time than the customers to pay.
Well, what is it? What is inventory? Well, Kevin made a good point online. Layaway sales. I don't know. Do customers do Walmart? Does Walmart do layaway sales? That would account for 4.4 days. Right? Where they're prepaying in increments for. I don't know. It's a good thought. So, what is the inventory? Sorry, just to continue to what you were saying.
It's an asset to have whatever cost of goods sold that's not being recorded for some time.
Give me what inventory is for Walmart. Tangible. What is it?
Products.
What kind of products?
Coca-Cola.
They're stock. It's the products that they don't say. It's just sitting on the shelves.
Yeah.
So you got to keep a little bit up there, right? 41.4 is probably good. They're probably making sure it's moving fast. Inventory, but it's more than 4 days, right? If it's 4 days, that means they basically have empty shelves, right? You got to at least have. So I just wanted to make sure you got something tangible to picture there. Okay, prepaid expenses. Let's pull in prepaid expenses. Prepaid expenses. Pulling it from the balance sheet. Okay. What do we look at there? What are you prepaying?
Rents.
Could be rents.
Insurance.
Yeah, absolutely. Right. What are things that you are billed for in advance? Maybe you don't know. Some often rent. You have to pay at the beginning of the month, right? Maybe health insurance. Some things. So whatever. typically, although you don't know, typically prepaid expenses is SG&A related. Okay, now we're coming across an important point. There are going to be some line items that might be a little vague, like this says prepaid expenses and other. Sometimes there are line items that just say other current assets. And you got to think to yourself, well, what could that be? So you might have to take a guess. Just know accounts receivable is always related to revenue. Inventory, always related to COGS. Accounts payable, always related to COGS. The other ones is a toss-up. Now with Walmart, we're pretty lucky because Walmart, if revenue has already been utilized, right? It has. If COGS has already been utilized, the only other expense line item is SG&A. So if you see something a little bit vague, like prepaid expenses, and you're thinking, oh, what expense are they prepaying? It's easy for us. It's got to be SG&A. Now, the trouble is, if this is broken up into 10 line items, and you got to think about, well, what expense are they actually prepaying? You can do some research. You might never know. If you don't, and we'll see this sometimes, I would just do like, total operating expenses and just do it off of the total. Remember, we're just looking for trends. So, and if our operating expenses are projected off of revenue growth anyway, it's not going to make much difference. You see what I'm trying to say? So in this case, if you see something like prepaid expenses or other, it's not going to be COGS, it's not going to be revenue. It's going to be some other above EBITDA operating expense line item. Here it's easy for us because we only have one, SG&A. We'll see more complicated situations soon. Yes?
What was the other component that's related to COGS? You said accounts payable
and inventories. So we're going to take the average, open parentheses, this year, last year, divided by revenue.
revenue.
Sorry. Thank you. Just make sure you're paying attention. OpEx times 360. Okay?
It is okay to use revenue? Is also
No,
changed?
I changed it. It was a mistake.
Okay.
F19. Yeah, you don't. No. No, prepaid expenses is not revenue. Usually just receivables is revenue, or maybe deferred revenue if there's a deferred revenue line. It'd be so. Nothing else would be against revenue. Okay? We're going to total the assets. 1, 2, 3, making sure not to include the days in there, of course. Okay, so let's pull in accounts payable. And we relate this to what?
Payable is
COGS. Pretty much always COGS. Okay, so we're going to take an average of this year, last year, divided by COGS times 360. Okay, 37.8. Accrued you okay? Have it? Accrued liabilities? Pull it in. What's accrued liabilities based on? What could it be based on? So it's not going to be revenue. Okay. Probably not COGS. It could be COGS, but we already used accounts payable for COGS. So they're not going to have two lines. Accrued liabilities is some expense that they still owe. So the only other line we have right now is SG&A. So we got to use SG&A. Now, again, this is another kind of sort of vague, you know, in this case it's easy because there's only one SG&A line. But if there's a situation where there's 3 or 4, then you got to do a little research, see if they talk about it, guesstimate, and when in doubt, just take the total OPEX. So we're going to take an average. And then, Kevin, I'll get to your question in a second. Divided by 2012 OPEX times 360. Okay? Should give you 86. Why is it, these are black because they're formulas. I put formulas in black. I put blue font as hard codes, assumption drivers. So when we make these projections, I do that in blue font. That's the way I look at it. Okay? Let's pull in accrued taxes. Okay. Oops. Okay. Mm-hmm.
What's the difference between accrued taxes and deferred?
Okay. Perfect. That's where I wanted to go. So what is the difference? What is accrued taxes? What's the difference between accrued and deferred? What are some differences? There are a few. Mm-hmm. Sounds also like deferred taxes.
Yeah.
Deferred taxes are the time differences between the tax that you owe and the taxes that you pay.
That's true. Yeah. I'll explain further. Mm-hmm.
Usually deferred taxes are paid
Uh-huh.
in advance.
Mm-mm.
But not all in the future.
No, they're a liability. They're owed. They're not paid. What else? What are other differences? Yes.
The deferred tax, you have obligation to pay, but you didn't pay.
Uh-huh.
And accrued tax is already, let's say, if you are last quarter of the year,
Mm-hmm.
that's still what already you know, all the government, but we have to wait for the end of the year to pay.
But it comes up at the end of the year. So it does, they're very similar, so that's why it's kind of confusing. But there is a little bit of a difference. The deferred taxes are created from timing differences between accounting for book and accounting for tax purposes. That we discussed last week. That's what deferred taxes is. So it's a matter of how it arises, right? So deferred taxes, okay, we're filing GAAP reporting, and then we owe these taxes, and now I'm going to file for tax purposes a different way, and suddenly the taxes are lower. That's deferred taxes, and it's usually long term. Accrued taxes is this. Accrued taxes is it's December 31st. Now it's March 15th, where taxes are due, right? And you say, okay, it's March 15, 2017. I owe $1 million. I can't pay that right now. Short term, different thing. So I say to the government, can I pay in make monthly installments? That's accrued taxes. It's short term. They say, okay, you can, but you got to pay by the end of the year. And that's why the days for accrued taxes is usually higher, 180, 270, because you've only paid like 3 months out of the year right now. That's accrued taxes. Accrued taxes is literally a bill that you receive from the government and you haven't paid it yet, like any deferred liability, like any accrued liability. Different than the whole timing differences, filing 2 reports kind of thing.
Deferred tax, we have the ability to pay, but,
Deferred taxes, say again.
so for deferred tax, we have the ability to pay, but, it's just the price of filing didn't match up with the.
Yeah, you might have had the cash or not, but because of the way you're filing it, yeah, it's causing that liability. Maybe you had the cash. You're choosing not to. Mm-hmm. That's exactly right. So, what line item do we look at when calculating this? Income tax. Yeah, exactly. So, average this year, last year, divided by 2012 income tax times 360. This one is interestingly just around 30 days. Actually, did I do that right? I don't remember it being so low. I guess so, right? 33? Okay. And we'll add up the liabilities. Okay. You guys got that? And our total working capital, the total working capital is our assets minus our liabilities. That is the total working capital. Okay, so it's negative, which is kind of saying we have more liabilities than assets. That may or may not be bad. We'll look at it once we analyze the whole thing.
You go back to that formula again.
Sure.
Yeah, thank you.
Mm-hmm. Okay. Let's take a break. And then I want to talk about projecting, interpreting into the cash flow, start talking about the balance sheet. Let's talk about making projections. So when making projections, we're going to use days as the driver. Yeah, yes.
Obviously, with the operating working capital, you're pulling directly from the balance sheet.
Mhm.
There's oftentimes more items, depending on the 10K that you look at.
Yeah.
There's oftentimes more items in the.
We'll talk about that. Yeah, he asked that. Yeah, we'll talk about that in a second. When we get to the cash flow. Yeah, no, it's good. First, let's project. I lost my train of thought. Okay, so we have these days. You could, although I don't know how necessary it is, go back one more year. You'd have to pull up a historical annual report and then get the 2011 days and then take like an average. Or I would still just do the last year, because to me last year is more indicative of next year's trends than taking an average of a couple of years. But either way, we would use that number and we would reverse engineer the formula that we just spoke about and back calculate into the projections, yes.
If there's 5-year historicals, then last year would be more accurate, right? Because you wouldn't take average of 5 years.
Right. Mm-hmm. So I would take 4.4, for example, and then now we want to do some algebra to back into how to project accounts receivable. And just so you have a good understanding as to how that works, if you remember, what happened? It just decided to disappear. It just decided to close. Wonderful. If you remember, the formula, okay, is AR, for example, divided by revenue times 360, right, equals days. That was the formula. Equals days. Okay. Now, that's the formula to calculate days. Now, if we're in a situation now where we have the days, okay, we have the days, and our variable that we want to figure out is the projected AR. Let me get some colors going on here. I don't know why my laptop is going nuts. Then, no. Okay, if this is what we want, okay, then we can just kind of reverse engineer this formula. Okay, we can divide both sides by 360. Right, if we divide both sides by 360, we'll get days divided by 360 equals AR divided by revenue. And then we multiply both sides by revenue, and you get AR equals days divided by 360 times revenue. Okay, and this should make sense if you think about it this way. Remember, we're getting a percentage, right? The days divided by 360 is basically, here when we had 90, is basically the percentage of revenue. Right? Before we concluded with 90. 90 divided by 360 is 25%. So you take that percentage and you multiply it by the revenue to see what percentage of revenue is left in AR. I want to make sure you're thinking about it that way. Okay, so days divided by 360 times revenue. So we're going to do that with each line item. So here for days receivable, we're going to do the days. 2013 equals days divided by 360 times income statement 2013 revenue. Okay? And you can copy that to the right. So I just want to make sure that that is what you're getting. Kevin, yes. In addition to what we discussed with deferred taxes versus accrued taxes before, you can listen to it in the recording, but we discussed the major differences. Okay, you guys got that? And same thing with inventory. So inventory is 41.4, and we're going to reverse engineer the formula. How are we going to do that? What's the formula? Hmm? By 360 times COGS. Yep, so it's the days divided by 360 times on the income statement cost of goods sold. Copy to the right. Okay.
Excuse me, you link 41.4 each.
I hard-coded. It doesn't make a difference, really. I mean, it's going to change the numbers a little bit, but I mean, yeah, just hard-code. Just so we got the same numbers, let's just hard-code it. Okay. What about days prepaid? Days divided by 360 times?
This comes out of operating expenses.
SG&A. Yeah. whatever line item we use to calculate the historicals, we need to use for the projections now. Okay. Okay, so this is what you should have for total current assets.
How did you just link the three previous things from the balance sheet for historical?
Yep. And make sure you have that. Let me know if you don't, if you want to look at numbers. Now we can continue. Accounts payable. It's the days divided by 360 times what? COGS. And if you forget, you could just look at the historical formula to see. It's COGS. Okay. Accrued liabilities, days divided by 360 times. What do we link that to? What do we focus on? SG&A. Accrued taxes, yeah, 29.9 is the 29.9 divided by 360 times taxes. Okay. Then we add those up and we copy over our totals. Okay. Okay. Does everyone have that? We now have to talk about, so this is our total working capital. So we're going to analyze it. But this is built really to match our balance sheet line items and our cash flow statement line items, right? So I want to talk about how each of these working capital line items are impacting cash. Okay, so for example, we have accounts receivable that's going down from 5937 to 5790. What impact does that have on cash? Do you know?
Increase.
Increase? Why?
Because anytime an asset decreases, there is an increase in cash.
It's true. That's right. So it's and in this case, you're collecting on your receivable. If the receivables goes down, you have collecting on those receivables, so cash comes in. So, and that's true for every asset. Right? If an asset is going down, you're collecting cash, or cash is going up. And the opposite happens. If an asset's going up, cash goes down. Well, that's true here. That's going to be true when we use the cash flow statement to drive the balance sheet. Okay. Here, inventory is going up. So which way is cash going? down. Think about buying inventory. The inventory balance has gone up because you've purchased. Cash going down. Okay. What about liabilities? If this liability is going up, which way is cash going? Up. Liabilities work in the opposite way that the assets work. If the liability is going up, then cash is going up. Think about borrowing money. You borrow money, you gain a liability, and you gain cash. You pay back a liability, the liability goes away, and your cash gets spent, goes away. Right? So if the liability goes up, cash is going up. There's a direct relationship. Right? What about working capital? If working capital total is going up, what's the impact on cash? Why? Yeah, yeah, yeah. You think of. I like to think of working capital. It's a net asset. It's asset minus liability. So it's basically a net asset. So it acts like an asset, right? If it's going up, then you got to spend more. Your cash is going out. If it's going down, then cash is coming in. That's the way it works. So we need to hold the understanding of the assets liabilities into the cash flow statement so we can link this in the right way into the cash flow statement. In other words, if the AR is going up, we've got to make sure that reflects as a cash outflow in the cash flow statement. So this match is going to help us ensure that that happens, because it is very easy for analysts to get that backwards or get that wrong or just not, subtract the right way. So this match, there will be several matches throughout the model that will help ensure that we're building things the right way, right? Which is a standard banking thing. This isn't something I just made up. So the change in total operating working capital, we're just going to calculate the year-over-year change, this year minus last year. Okay, you can see it doesn't match yet because we haven't linked this into the cash flow statement. But just calculate that. Okay. Got that? Now, let's go to the cash flow statement. Okay, if you go to the cash flow statement, in the working capital section, it's time to interpret the cash flow line items into this section. So we have AR, for example, right? And accounts receivable needs to link in from the working capital schedule, right? And in 2013, we had just said that the AR is increasing, so that should represent a decrease in cash, right? So we can't subtract 2013 minus 2012. We have to do negative the change, right? Negative 2013 minus 2012, right? Yep, decrease. Yep. So minus the change. So we got to go minus the change because there's an opposite effect. Okay, so 2013 minus 2012. It's minus the change, right? Does that make sense?
No. One
To
more time.
okay, because AR is reducing from 5.9 to 5.7.
Yeah, I understand that.
That should result in a cash inflow. So we don't want to do the change, which will result in a negative number. We got to do negative the change to give us a positive number. Yeah, negative the change. Right? This is the change. Right? That to represent cash, we have to negate that to show cash coming in. And that's going to be true for every asset. Every asset, it's minus the change because of you got to flip the signs when you go from an asset into. So for inventory, I do the same thing. Minus working capital. Minus 2013. Minus 2012. Yeah?
The reason why prepaid expenses goes down when cash goes up is because what?
Same reason. Same reason for every asset, right? If prepaid expenses is reducing, then it is basically a positive adjustment to cash. If prepaid expenses, bless you, is increasing, you've put funds into that prepaid expense account. So cash being reduced. True for every asset. True for every asset except cash. Okay. Now notice the next line in working capital is prepaid expenses. But notice there is no cash flow statement line item for that. Okay? Why is that? This is kind of to what Cortez was asking and to what we discussed earlier. Okay, well, this is something that you probably will see very often, that the line items you've identified for working capital do not match the line items that you see in this section in the cash flow statement. And there's a couple reasons for that. The biggest reason is because if you go to the cash flow statement and you go to this section here, cash flow from operating activities, it's actually defined as changes in certain assets, liabilities, net of effects of acquisition. It's not really operating working capital. Although we want to define it like that in banking. It's not a GAAP requirement to make this section be operating working capital. So what difference does it make? It's very similar. There are a couple of differences. One, this could include extraordinary items. It could. It could also include non-current items. And sometimes you might see changes in assets and liabilities here, and then maybe another line item, changes in non-current assets and liabilities. Remember, working capital for us is current. So what do? Well, you're going to have to do some matching up. The first thing I'd recommend doing, if there's anything in here that you know is not operating working capital related, then just pull it out. I mean, move it above this section, so that you're not changing the numbers, but you're kind of changing the layout a little bit. If you say something that's non-current or extraordinary, just pull it out, move it above here. That's fine. The next thing you're going to have to do is either consolidate or add rows where you feel appropriate. So for example, here, okay, in the, let's go down here, in the cash, in the balance sheet, okay, we've identified several line items. Okay, in the balance sheet, we've identified several items as working capital. We've identified AR, inventory, prepaid expenses. We identified AR, inventory, prepaid expenses. Okay. On the liability side, we've identified accounts payable, accrued liability, accrued taxes. Right? We can identify accounts payable, accrued liability, and accrued taxes. Okay. These are the line items that we've identified as working capital in the balance sheet. And I'll make this bigger so you can see. Okay. Now, however, in the cash flow statement, they only have, okay, that's not, there we go. In the cash flow statement, they have AR, inventory, accounts payable, accrued liability. So they have AR, no, that's not helpful. They have inventory, okay, that doesn't, AR, inventory, accounts payable, and accrued liabilities. Okay, so let me see if I can put this in here so it's a little bit easier to follow. Okay, okay, close enough. Okay, so what happened to the other two line items? So in the cash statement, they don't have prepaid expenses, and they don't have accrued taxes. Okay, so you have a decision to make. Let me show it this way. This is what does not exist in the cash flow. So either two things could be happening, right? You could say, well, the prepaid expenses were buried into one of the other line items, so you combine the balance sheet line item to match the cash flow, or you add one additional cash flow line item to link the changes into. And it's your choice. It's really not going to change the answer, no matter what you decide to do. But you can make some logical guesstimates. So for example, in this case, if prepaid expenses were to have been combined into another line item, what would it be? It's not going to be AR, because there's nothing, it's not related at all to AR, and it's not going to be inventory. It's not related to inventory. So I would actually say you cannot combine this with anything else. I would make this a separate line item. So we're going to add a line item in the cash flow statement. It'll be 0 historically, but the future projections would be the changes that we made. Okay? So I'm going to go to the cash flow statement. I'm going to add a row for changes in prepaid expenses. I'm going to link our working capital line item into it. So I'm going to do shift space, control shift plus, changes in prepaid expenses, 3 zeros for historicals. That's the only thing you can do. Otherwise, it'll never match, it'll never link, it'll never balance. So you have to make the decision. You got to look at the balance sheet line items, you got to look at the cash statement line items, and if there's a mismatch, then you have to say, well, that means I either need to add a line item to the cash flow or consolidate in the balance sheet to match.
So what's the reason that
We don't know what it is. Yeah. Yeah, we made it up. I mean, we could say, oh, it was 100 historically, right? But then the numbers will be different than what's reported.
but you can't, right? Because this one has to be 0 in order for it to be balanced.
Yeah, I mean, you can, yeah, I mean, maybe I misunderstood the question.
Oh, I'm just trying to figure out how we have prepaid expenses and working capital schedule, but we don't have that in the balance.
Oh, I see. Okay, so why is there a difference? This is good because this could be brought up. Why is there the disconnect? What are the 2 reasons? We just mentioned. What do you think? What are the 2 reasons why there's, what's the major, assuming this is what you're asking, but why is it different, first of all?
Consolidated to,
Well, that's our solution.
right.
But why is there a disconnect between the cash flow statement section and the lines we've identified as operating work on? What's the big reason, first of all? What do you think?
You don't have to report it.
They don't have to report it. Yeah, I mean, really, I mean, kind of, yeah, I mean, more or less, this is not operating working capital. We want it to be operating working capital because it's not a requirement. So, dig deeper. So what does that mean? What are the 2 major differences then? There could be more. What does that mean? What are the major differences between this and working capital? It's very similar. What are the major differences?
This doesn't have to be current.
Doesn't have to be current. It could have extraordinary line items. And so they're just classifying things differently. So we've identified like prepaid expenses of working capital. They might have buried it in somewhere else. It's got to be in there somewhere. So to your point, maybe this is where you're going. We could have assigned value to this, but if we did, we'll have to remove it somewhere else, right? Otherwise the numbers won't match.
Right. So, but now you add a line item, historical 0, that's fine, but you have prepaid expenses in the projection. So if you project everything else according to historical, then does that mean you're double counting?
It's possible. It depends. I mean, in reality, it's probably a part of like other operating activities. But we usually don't go into that detail. To dig it out of other operating activities, I wouldn't do that because we're really unsure of what it is. I mean, what is this going to come out to be? Let's look at what this comes out to be. So if we link this through, and we say, okay, negative It's negative the change. Okay, negative 2013 minus 2012. Okay, 773. So you'd say, okay, so we'll pull it out of here, and then this becomes negative. We just don't go into that detail. It's good thinking. Again, it's just... I mean, what you would do in that case then is you would just pull it out. You'd look at what it was historically, like back analyze. Okay, so it's 1275, and then say, okay, well, where does it could it logically have been buried in? It can only be other operating activities, which would make it negative. It's just a lot for a small impact. I like the way you're thinking about it. But we just don't do that. Yeah, as long as it balances. I mean, it's good. It's a good thought process. But yeah, we draw the line there in banking. Change in accounts payable. Okay. When you get to operating working capital, change in accounts payable. It's going up. So what's the impact on cash? Positive.
Oh, sorry, positive. Yeah.
Don't be sorry.
No, because I confused.
I'm joking. Good. So it's not minus the change, it's just direct change. So it's going to be equal to operating working capital this year minus last year. So for every liability, it's not minus the change, it's just the change. Okay? Same thing with changes in accrued liabilities. It's the change this year minus last year. Okay? Okay? And then we have the problem again. We have a line item, accrued taxes. Now, I created a separate line item for it. You could have argued that this could be combined with accrued liabilities. And if you were to do that, I would have just combined it directly in here. I would have just merged the two rows and then just did, 1807.701 plus 157. You could have done that too. It's a toss-up. And it's not going to affect the overall results if you see how we're projecting it so much. But in this case, I added the row. Let's do that. Changes in accrued taxes. Zero. 3 zeros. And then I did the change. This year minus last year, okay? And now because we did some row adding, just want to make sure that everything totals appropriately. So I got to recalculate here. And same thing historically. Okay, just to make sure that everything's included in the total. Okay.
Just with changes in accrued liabilities, if they give you, say, changes in accrued liabilities and in accrued taxes, right? Should you break it? Should you combine it in that case, or should you just keep it?
Yeah. If it had said, and we'll see this when we look at Hines. If it had said, sometimes you'll see this, and we'll see this in Hines, and then you have to combine. It might say here on the working capital on the balance sheet, accrued liabilities and accrued taxes. And then, on the balance sheet it says this, and then on the cash flow statement it says changes in accrued liabilities and taxes. Then you know that they combined it. Yeah, so there could be some clues. We'll see things like that in in later models. Yep, yep. If there are clues like that, then you know. If when in doubt, I mean, if it's a toss-up, it's a toss-up. But sometimes there are little indicators like that, then you know, oh, they must have combined it.
Sometimes in annual statements they put like accrued changes in accrued liabilities and other liabilities as well.
Mm-hmm.
Right. Then in that case, would I have to go to the notes and separate it out, or like you don't know the other liabilities are?
Did they separate out on the balance sheet?
No.
Then you wouldn't bother. Yeah. Now, notice 951.5 should, if I did this right, match 951.5 here. My match went from no to yes. That match is a check to make sure we've subtracted the assets the right way. We've subtracted the liabilities the right way, because that's a very common thing for analysts to do, is maybe to forget you have to do negative the change just for the top half. You know, this is a common problem, so the match helps ensure that. Why does that match work? Well, you're basically calculating changes in working capital two different ways. Here you're taking the differences and adding up the differences. Here you're taking the total working capital and then subtracting the totals. So you're either taking a difference of the total or you're summing the individual differences. You're calculating the same number two different ways. It's a great way to check and ensure your signs are going the right way. So if this says no, then you know you've done something wrong. So I'm going to copy this to the right. And we have done as much of the cash flow statement as we can before moving forward. And this should match all the way through. It does. Okay. You guys have that. Take a look at it. Just write myself a note to obviously email it to you with the reading.
Yes, sir. I just want to, it's a bit of diversion, but this was the match. Can you explain that formula to me? This is like if round minus the cash flow, yes or no, like this is match.
Yeah, so this is, actually you don't need the round, but this just says if, and we'll do if statements.
Yeah, but what about the round?
Oh, you want to know about the round? So the, well, the round is supposed to round the round function. Well, let's do it without the round first, because it actually doesn't provide a function here, and then I'll explain to you what it means. So let's basically, oh, we need the round, huh? Hang on a second, let me look at that. Why?
We need a one from is there one or zero?
It's not rounding. Oh, I know.
1 0.
There's a decimal difference? There shouldn't be. Hold on. Let me just pause this because this is going to... So, yours matches perfectly.
Yeah.
Okay. So, this is off by a 0.0000000000002. I gotta look into it. But what round does is rounds the answer to a certain decimal and kind of says cut all that off. So let me just show you the round form. So I'm going to go equals round open parentheses that value comma 1. Okay. It's going to round it to one digit. Round it to 951.5 to one decimal. Sure. If I do round 2, okay. So sorry. I think it should be 0.1. Okay, so this basically says, okay, let's take that number, round it just to one decimal is all I care about, right? And then now let me put in the if formula. Were you comfortable with the if formula? Okay, so basically what the if formula, for anyone else that's curious, is it basically said, let me round the answer. So that basically says if this plus this equals 0, right? If that plus this is equals 0, then return a y. Otherwise, return a no. Let me just show you what the formula is. So if, okay, I'll put the round back in. Round that plus that. If the answer is 0, then it matches. If it equals 0, then Y. Otherwise, no. We're going to do a whole thing on if statements, but that's just, but Y is off by 0.00000002. The only thing I can think about is that the historicals given were off by 0.00000002. And I had two options, either to force it or to round it.
Or be trying too hard so that you're A's.
Just that small little adjustment.
Yep.
Is it possible?
I gotta think that through. Could be.
You go to cell G23.
Mm-hmm.
Oh, G.
Okay. You guys have this number? Am I something different? Anybody something different? You guys okay? Okay. Okay. Working capital is done. Cash flow statement is pretty much done with the exception of the two line items that are related to the debts. Okay. So we just need to, we're not going to do the debt schedule yet. The debt schedule I recommend to be the very, very last schedule that we do. There's good reason for that. Let's talk about the balance sheet. Just quickly have time just to introduce it. As you know, let's formally talk about it. We've introduced it a couple times. The balance sheet is a summary at a certain point in time of a company's assets, liabilities, and equity on a given date. The balance sheet must always be in balance, no matter how we build it and project it, and the balance means the assets minus the liabilities should always match the shareholder's equity, or the assets should match a sum of the liabilities and equity. Right? I think you know that.
Assets should match the liabilities plus shareholders of the equities. Assets.
Mm-hmm.
The equity liabilities plus shareholders.
Mm-hmm. Yep. Two ways of looking at it. Same, just algebra. Yep. And an asset, as we discussed this morning, is a resource that has some sort of economic benefit, and it's expected to provide future benefit. And the examples of assets are cash, AR, inventory, prepaid expenses. Those are current assets. Examples of long-term assets are property, plant, and equipment. Goodwill. We'll speak about goodwill more when we talk about M&A. Liabilities are some sort of debt or obligation on the company. Liabilities are also broken up into current and non-current liabilities. Examples of current liabilities are short-term debt, accounts payable, accrued liabilities. Non-current are long-term debt, deferred taxes is non-current, any other outstanding loans like a capital lease, non-current. Okay. Liability. And shareholders' equity. Shareholders' equity is, I think about it in two major pieces. Equity invested and the retained earnings. The equity invested could be stock, could be preferred securities, any tier of stock, less any shares bought back, which is known as treasury stock. And the retained earnings is the net income in the business after distributions have been paid. So it's the net income minus dividends. That's shareholders' equity. And so what we're going to do is we're going to look at Walmart's balance sheet and lay things out. Probably just do it together. It's going to be quick. And get familiar with Walmart's balance sheet and then talk about how to project it. So just quickly looking at Walmart's balance sheet, It is also laid out, like the cash flow statement, the balance sheet we're pretty much going to lay out as they have it presented. It's not like the income statement where we have to move things around and organize in our own way. Cash flow statement, we did much the same thing. Cash flow statement, we laid things out line by line. Balance sheet, we're pretty much going to do the same thing. They have current assets, long-term assets, current liabilities, long-term liabilities. Right? Current assets is cash, and then the 3 working capital line items that we already have hard-coded in there, and then this one-off discontinuing line item. The long-term assets, we have PP&E, which we already hard-coded in, and then goodwill and other assets. It's going to be a pretty quick exercise. It's pretty straightforward. Liabilities, they're going to have, we're up to lay in the short-term debt, and then the 3 working capital items that we've already hard-coded in there, and then the other debt obligations, we just have to hard-code in quickly. And then long-term liabilities, we just have to hard-code in the long-term debt, their capital leases, and then deferred taxes, and this non-controlling interest that we'll talk about. Then in the equity section, they have preferred stock and common stock. Actually, the preferred stock line item has been zeroed out, so we're not even going to bother including that. They have common stock. They have this line item called capital in excess of par, which we'll talk about tomorrow. Retained earnings and other comprehensive loss. There is an important difference between the two. We'll talk about tomorrow, and then we're going to just total everything up and talk about how to project. So it just doesn't really make much sense to start that now.
Sorry, with the preferred stock, how would you go about projecting this? I know it doesn't have it in the balance sheet, but just as general tips.
Let's talk about it when we talk about projection in the section. Yeah, it'll make more sense. No, it's a good question. It's an important question. And we'll actually have to model out a whole preferred stock security for the Heinz LBO, because one of the biggest components of it is Warren Buffett has a preferred stock investment, and how do you think that through? No, it's good. I don't want to shortchange that question, because it's going to be a bit of a discussion, and it's dependent on a lot of the things that we're going to learn up here. So I want to go through that first. But let's do that. So tomorrow, all about the balance sheet, hard code it in real quick, start to project it out, and then we'll get it done tomorrow, and then we'll spend Wednesday on balancing balance sheets, and then Thursday we'll complete the model. Good. I will see you then.